I wonder how much of my salary should I put in mutual funds?
Are you someone who often has the same question? Yes, you must plan your investment in mutual funds to reach to your financial goals. It is really simple if you understand the 50s to 30s to 20 rule. Hello and welcome. I am Prarthana from ClearTax, India's largest tax and financial services platform. At Clear, we have assisted 6 million tax filers so far. Do subscribe to our channel to support us and get to know more about the best investments to reach to your financial goals. US Senator Elizabeth Warren popularized the 50s to 30s to 20 rule. It is a personal finance thumb rule that helps you build a financially sound budget. The 50s to 30s to 20 rule helps you allocate your money between needs, wants, and financial goals. According to this rule, you must allocate 50% of your monthly after-tax income towards needs and essential expenses, 30% towards wants, and 20% to investments to reach your financial goals. It makes you aware of your financial habits and prevents overspending and undersaving. The 50s to 30s to 20 rule helps you invest a significant expense such as buying a house or a car. It also helps you cut down on unnecessary spending, preventing you from falling into the loan trap. You can adopt the 50s to 30s to 20 rule if you don't want to make a detailed personal budget. You have to track only 3 significant categories: needs, wants, and investments. This table is showing the 50s to 30s to 20 personal finance thumb rule. Let's understand the 50s to 30s to 20 personal finance thumb rule with an example. You must first determine your monthly after-tax income. Set a spending threshold for every category, namely needs, wants, and investments.
Suppose you have an after-tax income of Rs 1 lakh per month. Based on the 50s to 30s to 20 personal finance thumb rule, allocate 50% of monthly after-tax income towards needs. It translates to Rs 50,000 or 50% of Rs 1 lakh. You must then allocate 30% of monthly after-tax income towards wants. It translates to Rs 30,000 or 30% of Rs 1 lakh. Finally, you allocate the rest of the 20% of monthly after-tax income towards investments to reach to your financial goals. It translates to Rs 20,000 or 20% of Rs 1 lakh.
You must pick investments to attain financial goals based on your risk tolerance. Mutual funds offer several investment options to attain your financial goals. You can pick equity funds that focus mainly on the stocks if you are an aggressive investor with longer time horizon. However, you can choose debt funds if you have a lower risk tolerance and a shorter investment horizon. Well, many investors opt for hybrid fund that invest in a mix of equity and debt securities. You can choose hybrid funds with a sizable allocation towards debt securities to attain medium-term goals. It actually cushions your portfolio against stock market volatility. Well, according to the 50s to 30s to 20 rule, you must allocate 20% of your monthly after-tax income towards investments. You can choose mutual funds depending on the type of financial goal. This table on the screen is showing how much of your salary should go towards mutual funds. Asset management companies offer you a systematic investment plan or SIP facility. It helps you regularly invest a fixed amount of money in mutual fund schemes of your choice. SIP helps you stagger your investments in equity funds over time. It is a better way to invest in equity funds than a lump sum investment, thus you can avoid the timing the stock market. SIP helps you average the purchase price of units and maximize returns over time, called the rupee cost averaging. If you invest in equity funds regularly, irrespective of stock market levels, you can purchase more units when the market is low and fewer units when the market is high. It helps you average the purchase price of units over time and reach your financial goals faster. Well, you can invest as low as Rs 500 per SIP installment in mutual funds. However, financial experts recommend investing a higher amount to attain to your financial goals faster.
Let us understand rupee cost averaging with an example. Suppose you invest rupees 10,000 every month in an equity fund from January to June in a particular year. Your SIP investment can look like this. The average purchase price of equity fund units was Rs 96, that is 576 by 6 over 6 months, and you purchased 625 units. If you invested a lump sum amount of Rs 60,000 in January, your purchase price would have been higher at a NAV of Rs 100 and you would have bought 600 units, that is Rs 60,000 divided by 100. Therefore, rupee cost averaging has helped you average the purchase price of units over time.
I hope by now you have understood how much of your salary should go towards the mutual funds. Comment clear if you are clear or drop your questions if any. Don't you want to know how SIP equity funds help you achieve your financial goals? SIP has the potential to help you create wealth over time. You must start SIP as early as possible and stick with them irrespective of the stock market conditions. Do not commit the mistake of stopping your SIPs in equity funds when the stock market crashes, as it defeats the purpose of investing in equity funds through SIPs. You lose the opportunity of accumulating more units when stock markets go down and the unit's net asset value falls. Do not stop your SIPs even if the stock markets are going up. It is a tempting prospect, but you are timing the market and even market experts can go wrong.
Suppose you earn a monthly take-home income of Rs 50,000 according to the 50:30:20 rule. You allocate 20% of this income or Rs 10,000 in equity funds through SIP. How much wealth can you create at a constant tenure of 20 years?
Use ClearTax SIP calculator to calculate the investment value. You can click on the link given in the description box below to use the ClearTax SIP calculator.
As you can see from the table, a monthly SIP of Rs 10,000 with indicative returns of 8%, 10% and 12% fetches you a corpus of Rs 59.29 lakh, Rs 76.57 lakh and Rs 99.91 lakh respectively.
Well, to conclude, use the 50:30:20 rule to fix your allocation towards mutual funds, especially equity funds. If you have a higher risk tolerance, use the SIP route in equity funds to reach to your financial goals faster. It gives you the rupee cost averaging benefit to maximize your returns over time. Thank you so much for watching this video. If you have any queries related to investments and taxes, please do comment them below. We will address them as soon as possible. Stay tuned for more updates and also don't forget to subscribe to our channel for finance related content. Take care and goodbye.